Hey guys, what's up? This is Eddie back at you. So I promised to do a video that kind of details the homebuyer fees that you can expect. So I'm going to start that right now. Hold 1 second. Let me share my screen with you guys. Okay, cool. So we're going to start with an FHA loan. So there are a couple of different loan products. One of the most popular is FHA. It's a government-backed loan. Um, And the whole purpose of the FHA loan is to incentivize home ownership. So it used to be in times past that this was the easiest loan to get. You know, it had the lowest credit score requirement, and it will give you the highest debt to income ratio. So you could qualify for more of a home. So typically when people today, since the credit score requirements now with Corona are about the same, around a 640, you may can get into some FHAs at 620. But typically the debt to income ratio is what helps people decide which one they're going to go with. Because with an FHA product, you can get up to, over 50% as far as debt to income ratio is concerned. Conventional is a little more conservative. Um, you may top out at 50%, but typically it's going to be between 40 and 50% depending upon, your situation. So we're just going to talk about FHA right now. So let's just say you had a purchase price of $150,000. All right, with an FHA product, the down payment requirement is 3.5%. So right there, your down payment is $5,250 right off the bat. So that's what you need to have. Now with FHA, they do allow someone to give you a gift, like your mom or your dad, a relative that, just wants to bless you with your down payment. They could give you that gift. So that is possible. But if that's not the case for you, then you need to know that you need to have that 5,250 down. Now the seller cannot pay that. You have to come up with that, or it has to be a gift. So 5,250. Now during the first 10 days, as I stated on the home buyer orientation video, that first 10 days is called your due diligence period. That's when you can have all of your inspections. So, and also that's when your earnest money is due, which we talked about that as well. So if the home is less than 200,000, typically $500 is what you can expect. So that's the number that I went with. That is negotiable. The seller, depending upon the market, the seller could, ask for more. Typically, if they see more, they feel more comfortable with that than 500. But in a typical market, 500 is acceptable. Okay. All right. So your earnest money requirement, once you get a ratified contract, well, once both parties agree, then that earnest money is due within 24 hours. So you have to go ahead and go to the bank or get that money order and get it to the closing attorney's office within 24 hours. All right. So that's $500. Then you have your inspections. As I stated, most buyers are going to get that home inspection. Third party come in, go through the house with a fine tooth comb, give you pictures, give you a report. That report or that inspection typically runs you around $400. All right. Your termite inspection, they're going to check for any wood infestation or any, water content of the home, any leaks, anything else like that. That's going to run you about $100. Your HVAC inspection, typically that's going to be $100 a unit. That's just to check out the HVAC unit to make sure that it's working properly. Now, typically these inspections are not mandatory. They're just up to you if you want to give them. Now, as your real estate agent, I'm going to always recommend that you get your inspections. You're going to spend 150, 200, $300,000. You need to know what you get beforehand. So this is a little amount to pay just to make sure that you know what you're getting. We definitely don't want you to sign, close on a home, and then a couple of months or a year later, you find out this major issue that could have been identified during the home inspection. So that's what these inspections are for. But like I said, they aren't mandatory for FHA loan types. So the first 10 days you can expect to spend that's $1,100 right there. All right, first 10 days. Now that second week, that's typically when the bank is going to send out their appraiser. So once again, the bank is saying, you want 150,000 of my dollars? Let me send somebody out there to make sure that this house is worth it, okay? So they're going to send out their appraiser. Typically, that's going to run you about $600. While you can select your own inspectors for your other inspections, home inspection, termite, and HVAC, the bank isn't going to give you that courtesy to select the appraiser. They're going to select the appraiser. They're going to send them out there. The appraiser, even though you pay for it as a buyer, the appraiser works for the bank. So you just need to be aware of that. So once you throw that appraiser or appraisal in there, that's about $1,700 right there that you're going to spend within those first 2 weeks for your inspections and your appraisal. All right, then you don't have to spend any money until you get to closing. So once you get to closing, that's when the remainder of your down payment is going to be due. So remember, for FHA at 150, 3.5%, your down payment requirement was 5,250. So at closing, you'll have to bring the remainder. Remember, you have $500 in escrow already from your earnest money. So that's going to leave you with 4,750. Obviously, if you put more in earnest money, you put 1,000 in earnest money, then that's $500 less, 4,250, and so forth. Now, that's just for your down payment. That's just for the loan. Now, your closing costs are going to be things like your attorney's fees. They don't work for free. These are going to be your lender's fees. These are going to be, if you move into a community with an HOA, you're going to have to pay that HOA up front. A lot of times they make you pay your home insurance up front. They do the tax allocation. So from the day of closing or the day before closing or the day of closing to the first of the year, the seller's responsible for those taxes. The day after closing to the end of the year, the buyer's responsible for that. So the closing attorney will go ahead and divide up those fees accordingly. All right, so you can expect just a good, I just like to estimate for my clients 3.5%. Typically if you have 3.5% for your closing costs, that's going to be more than enough. So 3.5%, that's another 5,250. So if you're looking at the total due at closing here, that's 10 grand due at closing. The total needed for everything, your down payment, your closing costs, and all of your inspections are almost $12,000. So that's what you need to expect. Now, as I mentioned before, depending upon the market, the seller can contribute to your closing costs. Typically, if you're in more of a buyer's market, that just means that there's a lot of inventory. There's a lot of different choices for the buyer. A lot of times the seller will offer incentive, for you to purchase their home. So they may, pay a portion of your closing costs. So with an FHA, they can pay pretty much up to 6%. So they can pay all of your closing costs. Depends on the market. Now, in the market that we're currently in 2021, that's not happening. They're not paying anything because we're in an extreme seller's market to where inventory is so low that every home that comes on the market, there's typically multiple offers. So don't expect for the seller to pay anything. So you need to go ahead and expect to pay this total of, at closing, the whole 5,250, and your total needed for everything, like I said, is around $12,000. So that's for an FHA loan. So just wanted you to have that in mind. We'll take a brief look at conventional, because that's the other loan type. Now, a couple of different advantages with conventional. One of the things that you have to have with conventional and FHA is what's called mortgage insurance. So with FHA, you pay the mortgage insurance premium throughout the life of the loan, so for 30 years. With conventional, you only have to pay it for 20% of the loan. So once you get the loan balance down below 80%, then they'll take that insurance premium off. So that could be, almost $100, depending upon your loan amount, off of your monthly payment. So some people like that. Also with conventional, the credit score requirements are a little more stringent. So 640 is typically what you're going to look at with conventional. Typically, if you have more money, in the bank, most of the people with the higher credit scores and more resources, they're going to get the conventional loan because over the long run, it's going to be to their benefit. So with the conventional loan, the down payment requirement is typically 3%. It can be 3 to 5%, but typically you're seeing these days 3%. So that means the down payment requirement for a $150,000 house will be $4,500 instead of the $5,250. Earnest money still the same, home inspection still the same, appraisal, everything else is the same. Your closing costs, I still give you the same estimate. So your total due here at closing is $9,200. Total for everything is about $11,000. So it saves you about $1,000, just about. All right, so that's just the conventional breakdown. Now, another advantage to the conventional is with FHA is government backed. So their appraisals are a little more stringent. They're going to make sure that the home is move-in ready. So if there are any major issues with the home, they're going to say, all right, we'll give you the money if the seller makes this repair. So it's kind of contingent upon something happening. With conventional, they pretty much let you buy whatever you want. You know, they say you have a great credit score, you have a great debt to income ratio, you typically have some cash on hand, so they're okay with you buying whatever. They typically don't have any restrictions on what you can buy. So a lot of times when people are looking for foreclosures and stuff like this, you don't want to go FHA, you don't want to go VA, USDA, all of those are government backed. So a conventional loan or cash is the way to go for foreclosure or short sale, something like that. All right, so that's with conventional. Finally, we'll go to USDA and VA. All right, so these are both government-backed loans. The USDA loan is to incentivize rural development. So you'll see this in Kershaw County, all of Kershaw County, certain portions of Lexington County, certain portions of Fairfield County. So some areas of Blythewood are USDA. So they're incentivizing rural development. So it's a 100% loan. So you don't have to make a down payment for this loan. Same thing with the veterans and the VA. It's a 100% loan. You don't have to pay any down payment requirement. So if you can get that, this is typically what most people want to go to. All right, so the first 10 days are still the same, your due diligence period. You're going to have that earnest money requirement, the home inspection, the termite inspection, the HVAC, and the appraisal. So still, you're looking at $1,700 there. Your down payment, this is the big difference. You don't have a down payment requirement. You do have to pay your closing costs. So 3.5%, you're looking at $5,250. Your total due at closing is just that, $5,250. Your total needed for everything, once you add in your inspections and your appraisal, almost $7,000. So there's a significant difference there. So if you desire to live in a USDA area, now they have some other restrictions. They have an income restriction for everybody in the household. Their income has to be counted. The debt to income ratio for USDA is typically a little lower as well. So you just have to get with your lender to make sure that you qualify for the different types. And typically what a good lender is going to do, they're going to take all your information, they're going to pull your credit, they're going to look at your debt to income ratio, and then they're going to go over your options with you and kind of tell you what they think is best for you. But remember, once again, you know, we work for you. So you make the final decisions. The lender's going to tell you what you qualify for and what your options are. So you can make the decision from there. But anyway, just wanted to give you guys that brief overview of the fees that you can expect. So especially during this time where we're seeing the stimulus, as I mentioned, tax returns, any kind of money that you can save, that's going to be to your benefit. Now, it's my desire to make it to where you have to spend as little as possible of that money. But there may be some situations to where you really love the home so much that you're like, listen, now I don't care about none of that. I want this home. So the more money you have, the more flexibility you're going to have. Prayerfully, you won't have to use it. But once again, it's better to need and not have. It's better to have and not need versus to need and not have. So just wanted to give you that information. If you have any questions, hit me up. Hope you guys have a great day. I'll talk to you soon.